Discover why Singapore REITs might be costing you money and learn strategies to boost your investment returns. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Today, we're diving into a hot topic that's been buzzing in the Singapore investment scene: REITs. Now, you might be thinking, Iggy, REITs are supposed to be safe and provide steady income. What's the problem? Well, that's exactly what we're going to unpack. Let's start with the cold, hard truth. Singapore REITs have been underperforming compared to the broader market. Many of them are showing downward trends. It's not just a small dip. We're talking about significant drops that are hitting investors' portfolios hard. Take a look at this chart. While the Straits Times index has climbed from 3,100 to 3,800 points, many REITs have gone the opposite way. For example, CapitaLand Ascenda's REIT dropped from 2.90 to 2.59. That's a substantial decline when you consider that many investors rely on REITs for stable returns. But why is this happening? The culprit behind this underperformance is high interest rates. REITs are particularly sensitive to interest rate changes, and the current high-rate environment has put a real squeeze on their performance. Think about it this way. REITs often use debt to finance their property purchases. When interest rates go up, their borrowing costs increase. This eats into their profits and can lead to lower distributions for investors. It's like trying to run a race with weights on your ankles. You're just not going to perform as well. Think about it. Now you might be wondering, but Iggy, REITs still pay dividends, right? Yes, they do. Typically, REITs distribute about 90% of their income as dividends, offering yields around 6%. But here's the kicker. If you're using a margin facility to invest, you might be paying interest rates of around 8% per annum. See the problem? You're potentially losing money even with the dividend payouts. This brings us to our next point. Diversification is crucial. Putting all your eggs in the REIT basket might have seemed like a good idea when interest rates were low, but in today's market, it's a risky move. Let's look at a real-world example. I recently spoke with an investor who got creative with their REIT holdings. They transferred their REITs to a Cash Plus account with Phillips Securities and used a margin facility to cash out 30-40% of the total value. They then used this money for a down payment on a Singapore property. They're covering the 8% interest rate with the 6% REIT dividend yield and topping up the 2% difference. Now, that's an interesting strategy, but it comes with its own risks. It's not for everyone, and it requires careful management and a solid understanding of both the property and REIT markets. So what can you do if you're holding REITs that are losing money? One option is to consider alternative strategies. Some savvy investors are actually trading REITs rather than holding them long-term. They use technical analysis to buy when prices pull back and sell when they rebound. But remember, this requires skill and isn't suitable for everyone. Before we wrap up, let's talk about some important considerations. First, investing in REITs during a downtrend can lead to continued losses no matter how low you buy. The overall market trend is crucial for making profits. Second, be cautious of rights issues. These can dilute your shareholding and force you to invest more capital to maintain your position. Lastly, and this is important, a return to near zero interest rates might be necessary for significant appreciation in REITs. But predicting interest rate movements is tricky business, even for the experts. So, what's the takeaway from all this? While REITs can still play a role in your portfolio, it's crucial to understand their current challenges and adjust your strategy accordingly. Diversification is key. Consider exploring other sectors that are showing upward trends. The Singapore market offers plenty of opportunities beyond REITs. Remember, smart investing is about adapting to changing market conditions. Don't get stuck in one strategy just because it worked in the past. Stay informed, be flexible, and always keep learning. If you found this video helpful, give it a thumbs up and hit that subscribe button. It really helps the channel grow. And if you want to dive deeper into REITs, check out my video, The Ultimate S-REIT Analysis Guide for 2025. It's packed with up-to-date strategies and insights to help you navigate the REIT market more effectively. The link is in the description below. Thanks for watching, and I'll see you in the next video. This is Iggy from the Investing Iguana, signing off.